Now we get to pivot into Europe and looking at what's happening over there. You know, there's some data points that have come out. This should be, I know I talk a lot, and hopefully this will be a little bit of a shorter segment, just because there's not as much information that's come out over the last couple of, last week or so. But now just let's dive into a bit more into the data points. And as we were saying, when we looked at December versus January, we continued to talk about how December was slowing down, and that really followed through into January based on the data we keep talking about, the high frequency, the mobility, and that we continue to see those degradation. And when we look at just France at the top, you can see that the industrial production, missed estimates by a pretty wide margin year over year. And we look at manufacturing, again, a bit more in line, but again, moving in the wrong direction overall as we headed into January. And January is going to be worse than December, which again puts them on a weaker footing as we head into the end of the Q1 and then heading into Q2 as well. So then when we look at, and the reason why just these two are obviously the two largest economies in Europe, they're going to be a bigger driver in terms of kind of how quickly can we see the European economy, really turn around. And Germany's been fairly, obviously a bit more resilient, but they also have a bigger export market. So they've been able to take advantage of the supply, the shortage of supply in the market, moving stuff through, even though the euro has been a hindrance overall in terms of just the cost of exports. So again, this has been a net problem because it makes their imports can be cheaper because the euro is stronger, but then their exports are more expensive. So again, there's a certain amount of back and forth when we're looking at some of these different data points. So when we look at Germany, the industrial production for December was fairly in line, slightly down month over month. The trade balance, still the current accounts balance moved up with exports, surprising positive. Imports, slightly, imports also better than expected. And the reason why that's a positive net on an economic level, you want to see imports increasing because especially when you're talking about Germany, which is going to import either raw materials or semi-finished products, and they're going to export finished products, you want to see both sides getting better. And obviously, just for current accounts, you want the export to be better than the import. And that was achieved. So this is going to be something to watch when we look at current accounts, because some of the German data got a bit worse in January, but has really started to get a little bit better in February. So again, there's going to be kind of this short-term drop and pop, and lock and pop, yay. So when we look at this, like France, Italy continue to be a big problem or a bigger problem, where Germany remains kind of the stalwart within the Eurozone in general. And that's really not going to change as we go into Q2 with Germany being able to I think, perform fairly well on an economic level. So then we look at Spain, the industrial output actually surprised to the upside, industrial production. But when you think about the data itself, as we were saying with the high frequency data that we show time and time again, that you actually had Spain was doing better than most because they were the first to go into lockdowns. They were the first to come out. So it makes sense to see some of this turnaround. The question is, January doesn't look as good as December did, so there will be some softening in general. And then Italy is going to be the bigger problem because Italy continues to weaken as they have that political strife, those political issues with Draghi, and can he form the government? And we actually are going to talk about that in a minute when we go through that in a bit more detail because it's a bit more nuanced. So when we talk about the euro area financial conditions, you can see that they're extremely loose. So when we talk about how loose they are, we also have to consider what is the CPI in the area. And when we think about the CPI in general, we actually had German CPI that was fairly in line to where it was, but it was an increase overall, which if you remember the VAT tax adjustments happened in January. So again, that increase in pricing was obviously going to push prices higher. That should move lower again. But when you look at the bifurcation within Germany in general, you have savings that have gone up, but you have wages that have fallen, and you have food costs continuing to rise while you have a fairly flat to down energy cost, which again, it's just a matter of what are you buying and how much is that draining from savings based on what your wages are at this point in time. So just looking at what's happening right now, you're going to continue to see this movement and things remaining very extremely loose in Europe as they're trying to incentivize some more activity, getting more liquidity into the market. Lagarde is going to do a lot of things, as right now we see the euro strengthening. It's now at $1.2122. I expected the U.S. dollar from when it was at about 89.30 to go to 92.60. It got to about 90.62 or so, and then hit a wall, and now was pared back a bit. I think there's going to be a lot to watch, and it's not so much how. It's not more. It's more less about the dollar and more about what the euro is going to do as we go through the remainder of the quarter. And this is just looking at that Eurozone CPI. So when we look at the Eurozone CPI, the survey was for that 0.9%, but then the actual was 1.4%. So as we talked about, we did have that VAT tax adjustment. We did see that adjustment overall. But you can see kind of how lumpy some of this inflation can be. Now, it'll pare back, but it's not going to come back to this below 1. It's going to kind of waffle back and forth, just like it did in something similar to 2015. We're seeing, again, more of those prices increasing along the commodity level that is going to keep this elevated across the board. Now, when we look at the Draghi component, when we're talking about the parliament, so initially, the five-star party said never in a million years, and now they're starting to come around to, depending on who you are within the five-star party. So they were going to have a virtual vote to see how the party was going to stand. And then they delayed it because they're not sure, and they're trying, the people who run the five-star party, which are typically anti-establishment and the largest part of both the chamber and the Senate, they are a bigger swing. So right now, it appears that if Draghi, because you look at that dotted line, is what he needs to have a majority, you can see that if he gets some of the five-star party or the Lega party, you can see that he would get the majority. So it's really not a question of if, it's a matter of who. Who is going to back Draghi, because he already has the backing of essentially a large part of it. And based on some of the data points, it could be mixed. It could be a piece of both parties that support him and then will put him into power. Now, that might be a problem, because if the five-star party pushes him over the edge, or overall, but if it's only some of them, then maybe they can pivot back at any given time, and then you can risk a confidence vote. But so far, he seems to have enough support from a mixture of the parties that this will become the future in general. And then the question is, what can Draghi do? They're waiting for some of his cabinet announcements to see, if that can push some people over the edge and get them comfortable to vote for him as a new leader of the parliament and the parties in general. Now, when we look at Eurozone retail sales, you can see that the survey was 1.2%. The actual came in at 0.6%. Still positive, but again, as we were saying with some pieces of it, the industrial production for some started to weaken. Retail sales weakened, positive but weaker into December, and specifically in Germany, you had a VAT tax coming back in January. So what we're expecting right now and what we saw is that January data is going to be worse. It's going to be negative again year over year versus where we're going on a go-forward level. So again, these are things to consider, because some of this is December data. And right now, what we've seen so far is the January data is going to be a little bit worse, and continuing this missing of estimates, or at least taking down estimates in general, because you can still beat estimates, but it can still be negative. So I'm just talking more about the trend of economic data in the longer term. Now, this is one, and the Twitter handle is down there at the bottom. You can see the Euro area core inflation, ECB staff projections, and the previous ECB staff projections. So you can see that Projections have been wrong many times before. They'll be wrong again. It's just what is the trend in general? And that's where we see this trend of that 1.2% out into 2023. You can obviously see 2021, that the spike back up. And it's going to be a matter of when you smooth that line, because it can be fairly lumpy given the different countries that are making up the Euro area, and just what is going to be those impacts in general. And we continue to see some of this inflationary push, given grain prices, food prices, commodity prices, that is going to be supportive of this. Housing has always been an issue, especially in Europe in terms of expense. So there's a lot of that that's going to continue through the remainder of 2021. Not to say that we're going to surge to the upside of 2%, but again, it's going to continue to trend that way on a obviously up and down basis, but the trend will be up and to the right. Then when we look at the construction PMI in Germany, this is what we were talking about in January, and as we came from December into January, there's that slowdown in general of just construction activity, and that activity continues to face some headwinds. And Germany's not the only one. And it's that bifurcation where some of the manufacturing is better, construction's slow, services are slow. So manufacturing has been the bright spot as services and construction continue to be that drag on the general economy, which again, it's still moving up or at least flat, because as again, PMI at 50 is just no real change. And you're seeing kind of this flatlining of activity in general, even though we have some of these headwinds as we look at the European economy and how quickly can they really normalize in general. And then when we turn a bit to the emerging markets, you can see the emerging market sovereign bond issuance and just the level of high yield. So high yield debt is at, in terms of value in the market of high yield debt, is at all-time highs as people continue to push, money in or try to attack the market and take advantage of it. And here you can see in January, we had B, double B, triple B, A or above. Obviously that high yield side continues to move higher as the share of high yield issuance on the 3-month moving average continues to trend higher for emerging markets. Again, trying to take advantage of the market. When we look at sub-investment grade, we want to see, okay, well, who's taking advantage of it? When we look at investment grade, India is a big part of it. When we look at Russia, not that they're investment grade, but just looking at where this activity is taking place, you continue to see the gross external financing needs as a percentage of GDP. So we're going to continue to see these countries come to market. The sovereign wealth, sovereign nations continue to require just, a significant amount of debt in order to keep their stimulus going, their economy going, which is, again, going to be a net overhang in general for growth as we go forward. And change in reserves versus change in short-term debt levels, and this is where we start to see the overarching problem of the 5-year changes in the short-term on those debt levels. So when we look at India, which is FX reserves have risen faster, that's a positive. You want your FX reserves to go up because it helps mitigate some of your inflation fears. Because if you have more FX reserves, there's more dollars and euros and other currencies to help stabilize your balance sheet in general. So that's something that you want to see, where as you get to the bottom right, you start to have a bit more of a concern in terms of how are you going to protect against inflation. And that's why when we look at India, it's very important to appreciate what are they doing in general, because they did take their budget higher. They took things open in general. So there's some concern about what inflation is going to do, especially if they start to burn through some of these additional FX reserves. And then when we look at Turkey core CPI, the survey was for 14.6, came in at 15.5. So we're starting to get a reverse higher of CPI in Turkey. Again, that's only going to get tighter and a bit more problematic as we see the additions of, obviously we've been talking about grains, commodities become more expensive as Turkey is an importer. They do export a decent amount, but they are buyers of commodities in general. And that's going to weigh on their total CPI as inflation fears continue to move up, which is something the central bank has been very concerned about and has been very proactive in trying to address. Same with India, but again, there's going to be some differences because India has seen inflation fall back within their band. They're still at the higher end of the band, but they still fall back within a comfortable range. But now with the government trying to issue more debt, spend more money to stimulate the economy, this is going to be an overhang to watch to see how much economic activity can be generated in some of these areas as we go through the remainder of the year. So now that we kind of went through that, now we're going to shift and we're going to look at Asia and a bigger focus on, shocking debt and rates with a bigger focus on Chinese issues that have come to pass over the last month or so. And what does that mean as we go through the remainder of the quarter?